Guys, the markets are up big. The Fed kept rates the same. You would have thought they cut rates with how much the market has skyrocketed today. We're here to explain why and talk about what that means for the future. Now, keep in mind, guys, Fed policy does not change the way in which we invest. It is one of the millions of data points, because if you look at it, since March of 2022, rates have gone from 0 to 5.25%, and yet stocks are even or actually a little bit up. And today they're up again. It absolutely boggles my mind. Mo, Fed Chairman Powell has not spoken yet. He's starting probably a minute ago. Yeah. But right now, what are you reading here in their FOMC statement?
So this is from their press release. Recent indicators suggest that economic activity has slowed from its strong pace in the third quarter. Job gains have moderated since earlier this year, but remain strong. And the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. I thought this was interesting. The banking system is sound and resilient.
After several banks failed in March and April, and all they did was just say, listen, we're not going to worry about your balance sheet. We're going to backstop everything. You're fine. Don't worry about it.
Yep. The committee is still seeking to achieve maximum employment and inflation at a target of 2% over the longer run. And today they made the decision to sit tight at 5.25% to 5.5%.
Now, everybody in the markets is hoping. I'm reading that people expect 6 rate cuts next year. Guess what? No one has a clue. There's another finance guy on YouTube who last year said to us that rates would be cut early this year. Of course, it didn't happen. Now, I just look at this saying, why do you even try to make a guess? Why even try to guess? Guys, your job as an investor is to live within your means, save your money, dollar cost average, and learn a process, if you want, on buying great companies at good prices and dollar cost average as long as your thesis is correct. And the same. Now we look here. Mo, you pulled up an interesting scatter plot here. Yeah. So what changed in the last meeting versus now, the median interest rate from the FOMC committee has dropped for 2024. But that's from the last meeting to now. Mm-hmm. From last year, Mo, why don't you go through that for 2024?
So this is the December 14th, 2022.
So a year ago tomorrow.
Yeah. And we're looking at what their projections were for 2024. So this is basically 2 years out for them.
Correct, for another full year.
And you can see that the consensus was kind of around that 4 to 4.25%. That's where interest rates were going to sit. Now, when we look at today's, we're looking at 2024. The majority of Fed presidents are kind of sitting at 4.25 to 5%, somewhere in that range. But you can see that they increased their number.
Because they raised rates much more this year, probably than they even expected to do last year. Yeah. But overall, like I said, the expectation of 5.1% for next year as an average fell to 4.6%, and that's a big reason why stocks skyrocketed. Their projection for next year has decreased as maybe they're thinking to themselves, hey, things could, look, core inflation is still at 4%. Their goal is to get it down to 2%. And remember, core inflation excludes the very volatile energy and food prices. If you look at oil prices, they're down 12 or 13% this year. And they were up at one point like 16 or 17%. So that's a big drop from their high this year. And remember, if oil prices fell 20% tomorrow, it's pretty quick when you see changes at the gas station. So that's why those energy prices do matter. You look at gas, you look at natural gas. Natural gas is down a ton in the last month.
This is from the Bureau of Labor Statistics. I believe this came out yesterday, if I'm not mistaken. CPI, was that yesterday or the day before?
Yesterday.
So you can see food was up 2.9%. Gasoline, like Paul was just talking about, that had the big cut to it, down almost 9% yesterday.
Fed Chairman Powell says U.S. inflation remains elevated, path forward uncertain. Guys, he has said in the past, his main goal is to keep prices lower. He said inflation hurts families far more than the 2 million people who would lose their jobs because of recession, because of increasing rates. And guess what? It didn't happen yet. Does it mean we're out of the woods yet? I don't know. We've had an inverted yield curve since July 6, 2022.
Yeah.
That is 17 months, and there's been no recession called.
We're not even close to a reversion, call it.
Isn't that incredible?
Yeah.
What's the spread now, Mo? Let's go look at the spread now versus... Guys, so what this means is the reason the inverted yield curve is a predictor of recession. I think the last 8 recessions were preceded by an inverted yield curve, 2-year to 10-year inverted yield curve. If you lend money to somebody, the longer you go out, the higher the rate you want, because you're tying up your capital. There's more likelihood of something going wrong in a longer period of time than a short period of time. Okay, great. So when the 2-year is higher than the 10-year, it means people see the short term being riskier than the long term. That's why they think that's recessionary. Mo, what'd you find?
So the 2-year is sitting at 4.5 on the nose. The 10-year is at 4.06.
So 0.44 difference.
Yeah.
But where has it been in the past?
In the past, I mean, you can come here to the Treasury's website and you just start scrolling. All right, so here, you have the 2-year here, 10-year here, and you can see that the spread's pretty consistent back in August. Let's continue on. Let's see what happened in...
That is all of August.
This is all of August, so let's go... Let's just go all of 2023. There we go.
All of 2023.
And you can see.
Oh, Mo, look how big of a difference.
Pretty separated there.
Yeah.
Let's go through. Let's go to
So the gap is lessening.
Look at this one in March. This was
0.9. Wow.
Let's go.
And that was when the whole bank thing was going down.
Yeah, here got a little bit pretty close.
Yep.
Kind of the same we're at
0.5%
today.
still.
Summer back to 1 almost.
Wow, 1.
Let's go to September.
0.7. Okay.
So it's definitely closing, but let's see where it goes after today.
Yeah, guys, and again, that is just what the past has done. Doesn't mean it's a guarantee for the future. Would I still bank about that one? I mean, I still look at it going, guys, we just did another video where we talked about the layoffs. Things you didn't even hear about 2 years ago. And granted, it's smaller, but you see a lot more companies laying people off. The one that kind of made me go, was Hasbro, the maker of toys. If they're laying off 20% of their employees.
Especially going into Christmas.
Yeah, especially going to Christmas. What does that say about the consumer?
Yeah.
What does that say about the consumer? So what are some of the changes, Mo, in the words the Fed used last statement to this statement?
So this is an interesting article from Market Watch. This is from the September statement. Recent indicators
on the economy.
On the economy. Recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Come to today, growth of economic activity has slowed from its strong pace in the third quarter.
And we had a really strong pace in the third quarter. It was like, it's been like updated like 5.1% real growth. That's a big jump. And guys, remember, I announce my stock market to GDP ratio every 2 or 3 days in our community. And a big driver of keeping that rate down is the economy getting better. If GDP goes up, let's say GDP doubled tomorrow, stocks are undervalued. So that is a good driver for lower valuations and better opportunity to buy.
Yeah.
Okay. So what else are they saying on inflation?
Here's September on inflation. Inflation remains elevated. That was their September statement. December, inflation has eased over the past year, but remains elevated.
You know, it's interesting because the core inflation rate's still 4%. Already coming at 3.9. And I think it was 4% still.
It was 4.
Yeah, and I'm looking at going, that's still double where they want it to be. Okay, keep going, Mo.
So this one is on future rate hikes. In September, in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. Now, in the December statement, they said in determining the extent of any additional policy firming. So
what does that mean?
I don't know what that means.
I don't know what that means either.
I don't know what else they can do. Maybe there's some fancy things they can do, but they kind of, any means they can go anywhere they want now.
And now look, S&P is up almost 1%. Dow's up almost 0.9%. NASDAQ's up almost 1%.
Okay.
I mean, big jumps here, guys. Big jumps.
You've been speaking for 10 minutes?
10 minutes now. Yeah. Okay, Mo, what else you got here?
So you can see Powell is speaking. We are prepared to tighten policy further if appropriate.
Now, I'd have to think they'd have to see a pretty big jump in inflation for that to happen. Now, remember, guys, if they decide to lower rates, the question I have to ask you is, why would they lower rates? If they get core inflation at 2% next year, do you think they're going to say, okay, we're there, we're going to raise rates, we're going to decrease rates? No, because then inflation will probably go back up. The reason they would decrease rates, in my opinion, is a slowdown in the economy. Is that really where you want to be? Or is that an optimistic look for the stock market when the economy is slowed down? If we do hit a recession, that's not a good thing. Guys, we're here to talk about high-level views on the economy and the stock market. We don't believe in looking at small data points here and there. There's a million things to look at. We care about the high-level things and what they mean. But again, if you have a great process, if you save enough money and you live within your means, you're going to do great no matter what. And you should encourage bad markets and recessions.